All right, we continue to have this bifurcated market. Previously, the bifurcated market was small caps doing very well and the Qs dropping and starting their intermediate pullback. Everything else very bullish, led by the Russell. Not the case now. Now the bifurcated market is the Nasdaq really hasn't done very much and it's still stayed down. It hasn't really dropped very much anymore, but it's stayed down. The Russell is now dropping like a rock. But the S&P and particularly the Dow are at all-time highs. So what do we make of that divergence? And what does that mean for us going forward? And will it bleed itself over into the broader market? So we're going to break down the technical indicators, especially on these bullish indexes, to see just how bullish they are and what we can expect to see going into the Easter weekend here. We're also going to break down this kind of what today's move was. Was today a risk on move or was it a risk off move? So I'm going to break that down as well and see what really led us higher today from an asset class and as well as U.S. equity sector standpoint. And then we'll take a look at our trade idea of a stock that's kind of mimicking the NASDAQ 100, and we'll talk about how to trade that. So let's go ahead and get started. Today is Monday, March the 29th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see a little bit of a sideways day we had today. A little smaller, pretty decent range, but closing right where we opened the day, a little bit lower than where we closed on Friday. So not that bullish for the day. Bullish enough. We held the highs on the S&P at least. You'll see here in a second. That wasn't the case for everything else. But we held the highs here at least for the S&P. So we maintain dark green shading and a green line. We're just not getting up to new highs, right? And you can see we also did maintain strong enough close that the near-term line, the blue line down here, stayed in the reversal, or got up in the reversal zone. That's a pretty good bullish high. It's the highest level that we've had in a while on the near term line after getting one of the highest levels for the momentum line that we've had for a while. So very, very good short term sentiment for the S&P. Momentum line dropping, which is not surprising when you get a lower shadow like that, but not dropping to extreme low, so not a big concern. And then you have market sentiment and long term and the intermediate line, both rising. That's the case also for the Dow Jones. The Dow Jones was very, very close to a cluster on Friday. And then you can see the intermediate line is now back in the upper reversal zone, well above the 30-day moving average. So very, very good strength for the Dow Jones Industrial Average. Also has rising market sentiment. But then that's it, right? That's not the case for the NASDAQ and the Russell. The NASDAQ is still below its 30-day moving average. The intermediate line actually turned down today, and so we're back to dark pink shading in a red line, so complete opposite of what you see on the S&P. We did get a pretty decently high near-term line. Now the question is whether it's going to stay there, and considering what it's done in the past, we wouldn't expect it to. So I actually expect that near-term line is going to drop tomorrow, which means we'll probably get a drop on the NASDAQ tomorrow. You look at the Russell, and that was the worst performer today by far, flirting again with that 23% retracement level that's flirted with a couple of times. Not so much over here. Over here it was, if you notice, this is where it was at. We didn't close below that line, the 23% line. But up here, we did close below it, got right back above it, and now we're closing a smidgen below it this time. And again, the near-term line is kind of peaking without getting above 80, and then the momentum line dropping back to extreme lows. That would suggest that we would get more weakness tomorrow. So there's an opportunity for both the NASDAQ and the Russell, which again, both have dark pink shading and red lines. You would expect that you'll start to see some of that weakness show up on some of these other indexes too, especially like on the Dow, considering how bullish it is. That's a pretty decent sized move up above the 30-day moving average. If we were to kind of measure that here over the past year, so this would obviously include, 30-day simple moving average, sorry. There we go. So you can see we're in about the 65th percentile the past year. To kind of give you an idea for some perspective's sake, that's not that bad. The reason why that's such a low number, and it's actually 75th percentile for the last 5 years, is because these two were just so high. That was such a high level there. It was such a high level here for being above the 30-day moving average. It's not that low right now. It's a pretty decent sized move for the Dow. And then, of course, the S&P 500. Not as high above the moving average because we were just barely below it briefly. But short-term sentiment very bullish. And we're above, again, it's being above the moving average. And it's rising. You've got that combination of dark green shading and a green line is a strong bullish combination. The question is, how much longer can it hold up when other indexes are not even close to that, right? Or have either started an intermediate pullback that's been going on for a month, or appears to be just starting an intermediate pullback. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, that you liked our video, of course. And number two, that you want us to do another video again tomorrow. It's a quick way to give us feedback and let us know what you think. If you don't like our videos, of course, you don't even have to click on anything. You don't even have to watch. But if you do like our videos and you want to let us know, and we really do appreciate it when you do, you can do it with one click, just on that thumb right now even while you're watching. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website on marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle up there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our website, just come down here, click on some of these other things over here on the right. All of our trading rooms are over here listed, as well as our Market Outlook live video. So every day I do the Market Outlook. I do a live video at 3:30 Eastern Time. I review all the trades that we cover in these Market Outlook videos. We continue to trade them until we finish them. That's what we talk about in those videos there. All of our paid subscribers, our premium and our monthly subscribers, get access to all of our trading rooms as well as our Market Outlook live videos. Of course, our premium subscribers get access to more than that, including our class forums and premium tools. So check that out. You can get details in either one of those, or you just click on pricing right there. Come down here, click on that heart. It opens up a new tab. Hit that like button right there. Also come here, hit that thumbs up icon. Opens up another new tab. Hit that like button again. The more people that do that, it benefits us. Because the more engagements these posts have, the more Twitter and Facebook will promote our content to all of our followers. People actually follow us on these accounts. So it really helps us. We do appreciate it when you do that. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, now let's get back to the charts. Let's take a look at how the weekly charts are starting out. You can see for the S&P, again, we're only one day in, so take this for what it's worth. A big grain of salt there. But it's a pretty good bullish candle for the S&P. Not so bullish on the Russell. And we talked about that last week, how we tend to fill in lower shadows like that. And so far, we filled in about half of that in one day. I think we'll end up filling the rest of that, at least by the end of this week, as we mentioned, going into next week. If you look at the candle, the candle for the NASDAQ 100, you can see we're still stuck with these transition candles right smack dab in the middle between the 23% line on top and the 38% level on the bottom. The question is, which one are we going to break first? With momentum falling, you would expect they'll probably break the 38 first. Not that we'll go down huge, but probably come down into this 12,200 area in that spot before we find some support on the NASDAQ 100. Remember, the support's not very far away on the NASDAQ. It's a lot further away on the S&P. There's not very much support until you get all the way down here to 1,800. There'll be a little hiccup on the way right there at 2,050, but your stronger support level is down there. So, because we moved up so far, so fast, so suddenly, it's going to be hard to keep it from really making significant moves to the downside without the volume support to hold us up like we have on the NASDAQ, which has been more gradual in this significant moves to the upside, a lot more gradual than the Russell, where we didn't really get going at all until just recently, until the election, right? That's when things really took off and we finally broke through the pre-COVID highs. See, we broke through the pre-COVID highs back in June on the NASDAQ 100, and it's been a lot more gradual, moving up a lot higher for a lot longer period of time. Of course, the S&P 500, we're still very, very high PPO, very high PPO. See, it started to come down the NASDAQ. It's still relatively high, but not as nearly as high as it's been. And you can see it's already starting to roll over on the S&P, on the Russell too. Not on the Dow at all. It's still peaking on the Dow. And just to kind of give you an idea how strong it is on the Dow here, give me 1 second to pull up this chart, and we'll keep it on the 1040 weekly. And let's go out like 20 years. It's in the 94th percentile. The only times that it's been higher over here, we got to 9.14. We're at 7.68 right now. So it's not. There hasn't been very many other times that the Dow Jones Industrial Average has been this bullish. One of those being, of course, what we saw there in the beginning of 2018. You can see here in 2011 as well as 2009, and of course 2000. Coming off these real significant bear market lows is when you would expect them to be the most bullish. And when we get them, when we're not coming off of bear market lows, that ends up being a top for that point. And of course, I've shown you this chart, but if you look at the, excuse me, sorry, I had something stuck in my throat there. Let's take a look at the weekly chart on this for the Dow Jones Industrial Average, and you can see just how bullish that's been. Oh, see, this is on the S&P. Let me get the Dow Jones up here. There we go. Here, let me get rid of those arrows. It tends to throw things off. There we go. So you can see just how bullish. This is the negative index, the positive index. You notice didn't get very bullish at all during this time frame. Has been above 25 this entire time. But you notice it doesn't really get above 25 very much. We did get very strongly bullish there, but this really threw things off. This big decline, big rapid decline there. Otherwise, you notice over here, during a lot of that bullishness, we had a surge, but not very bullish there. Surge, not very bullish. Not very bullish during that bullish run. Not very bullish during these two bullish runs until we had that little surge at the end. QE fueled surge, no less. But again, it kind of shows you just how strongly bullish we've been to be up above 25 for that long, for that sustained period of time. That ADX probably should be a little bit higher than it was. The only reason why it wasn't is because we couldn't get up high enough on the positive, or low enough on the negative index, as you saw when the ADX got that high. I mean, look at that sustained run coming out of the election in 16. Look at that sustained run on the Dow Jones for over a year, all the way up to that early peak in 2018. So not as parabolic now as then, because we're coming off a much bigger low point now than we did back then. Here's the 1 year version of it. You can see we're relatively bullish there, had the biggest positive early, and now you can see the negative index has been progressively getting lower highs with these lows here, lower highs, and the positive index is up. So strong move on the Dow Jones Industrial Average. More of a bearish move on the Russell. Look at how high the negative index is and how low the positive. That ADX is rising. That's what you see on the NASDAQ 100, right? You see that on the NASDAQ 100. You don't see it necessarily on the diamonds yet. So let's go back to NASDAQ 100. The ADX has been very strong. It's been coming down. It's still at least up above 20. The question now is, are we going to get another leg up on this negative index, another leg down on the positive index? That's what you would expect to see with us kind of hovering here at resistance and potential rollover in the cards there. Let's take a look at the Bollinger Bands for the Russell 2000, and you notice, or let's go IWM so you can see the volume. You can see how significant holding this support at the 23% line is, because if we break that, there's not very much volume. Little stair steps here, but not very much volume all the way down to this 160 level on IWM. So that's why this is so important. That's why it's still holding up as well as it is. But we are back down into the lower quartile of the range. That's a pretty bearish drop for IWM. The Qs are still hovering at the midpoint, but unable to get going strongly up above because you got a significant volume node holding it down, acting as a resistance level in this case. All right, now let's take a look at the intraday chart. Look at the S&P 500, really flirting with a new 4-week high point, just like that. But again, unless we get a new high point here tomorrow or soon, then remember in a few days the low point's going to switch from these lows to this one and then to that one, right? So that means the low tag is going to move back to the right of the high tag unless we get a new high tag, and it's a pretty decent reality on the S&P. We're very, very close to it on the Dow Jones Industrial Average, but nowhere near new highs on the Qs. We're not going to get a new high anytime soon, and the high is going to stay right around here for a while, but at least it is going to move to the right of the low tag, so that's a positive breakout there. IWM, the low tag, you notice, is going to move from here to here, so the low tag will still, the high tag has actually been on the right for small cap stocks. It's going to move, the low tag is going to move to the right here in just a little bit, and for that matter, we might be getting closer to another new low sooner rather than later. That IWM is the one that's closest to forming a new low out of all of the indexes. You notice the S&P and the Dow are close to 4-week highs, which again kind of shows where they're at, because if they break support levels, they've got a lot of room to fall. In the short term, they don't have a very good margin of safety, whereas some of these other indexes like the Qs do, because it's already lost some, and IWM, of course, is already down at these levels that those other indexes are not. So you can see over the intermediate term, the Russell 2000 got the most to lose, but here in the short term, if there is any kind of near-term declines as a whole, with all these indexes with near-term peaks right now, are moving up to high levels on the near-term line. If we do get a near-term pullback, a broad-based near-term pullback, the S&P and the Dow have got the most to pull back, to drop, to catch down to where these other indexes already are. If you take a look at today's, let's take a look at the 3 green arrow chart. You can see on the S&P 500, we did get 2 new green arrows. In fact, we are above the 8-day moving average on the S&P and the diamonds. Not the case on IWM though. We're back below the 8-day moving average. Not the case on the Qs either. We're still flirting with that 17-day moving average. We're just a little bit above it again for the second consecutive day. But you can see how the lines are converging. So you expect that we'll get a divergence now. With the lines converging here, we'll get a new divergence. That's what MACD stands for, moving average, convergence, divergence. Are we going to get a divergence with a breakout to the upside, or are we going to get a divergence with a new move to the downside? And the latter would be what you'd expect more than the former, considering the current trend on the market. Again, as I mentioned, the volume at 108 million. The trading range, though, got considerably smaller, down less than 4 points. That is actually below the average of the ATR at 5.5 points. The volume just a smidgen above average. So we're dropping a little bit, but not enough, right? It's when you get below 1%, that's when you're strongly bullish. And while we were just under 4 points, that was right about at the average there. So, you know, it's got a lot more room to be really bearish before we really signify the beginning of a trend. You notice the historical volatility still hasn't really, in fact, the historical volatility on SPY is dropping at the same time that it is rising on IWM and rising, or was rising on the Qs. It's starting to pull back a little bit, but you can see how we've had that surge on the Qs that we haven't quite yet seen on the other indexes, Dow Jones or the S&P 500, as we still maintain very, very low levels. In fact, when you look at the volatility index itself, we did jump up higher today with a new week. We did jump up to a higher level, but still below 90%. The 90% mark still acting as a support level. But the gradual move higher would suggest that the mid to high 20s are in the cards here sooner rather than later for volatility. All right, so just to summarize our technical outlook, we are getting some weakness again. We had it in the NASDAQ. It's slowed down, but not reversed in the NASDAQ. It's transitioned out to the Russell, where we're getting a lot of weakness in the Russell, but we're still very strongly bullish in the in the Dow, and still pretty strongly bullish in the S&P 500. So we're still not seeing the broader sell-off, especially in those large cap names, as we are seeing in some of these other indexes that we expect that will eventually make their way into these large cap indexes. So there are some signs of at best that we are seeing signs of kind of a neutral move, a trendless move, just biased to the upside. But as we saw in the Russell 2000, we are more pointed towards the beginnings of an intermediate pullback that, again, we've already started and been in for a month plus on the NASDAQ. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What indicators or charts are you looking at that tell you not to expect, as I am right now, another bearish near-term drop here as early as middle of the week here, going into the holiday shortened week? I expect that we'll have that bearish near-term. The near-term might be dropping back down by the end of the week. So if you disagree with that, let me know what indicators are telling you why you're either a lot more bullish than I am, or that you expect will be a lot more than just a near-term pullback by the end of the week, with whatever charts tell you to be a lot more bearish than I am. Share those in the comment section down below. All right, now let's take a look at what's driving the price action here today. And you can see the biggest mover today to the upside was the dollar. The S&P actually stayed up pretty strongly too, thanks to a lot of these, as you'll see, the different sectors, but these QQQ type names. On the other hand, though, look at the Russell. And the Russell 2000 was just a big, significant loser today. And you see that had an impact on the relative strength chart that I've shown you before. But really, you can see bouncing back up here to these levels that we saw a few last week before dropping back below the moving average. The 8 and the 17-day are crossing back up above the 30 now. The MACD is very strongly bullish. If I go to just a one-year chart, the MACD is strongly bullish and rising. It hasn't been bullish this whole time. The CCI is well above 100. The RSI is well above 50 again for the first time in a while, making its way potentially up above 60. So very, very strong moves. And you can also see too now the PPO has crossed to being positive. So now the PPO has crossed above its moving average for the first time in a very, very long time. We've been negative this whole time, pretty much since the middle of September. So it's hard. You don't get a whole lot of crossovers on the long-term chart like this because it moves so slowly. So that's a pretty significant change in the Qs relative to IWM, and you see that here. That is a significant drop, and the strong dollar has actually kept gold down too. So let's take a look at some of those charts here. Let's start off with first of all the Euro US dollars. Let me pull that up here and see the dollars move here today. And you see that it's still very, very low compared to that 30-day moving average. In fact, when you look at how far below the 30-day moving average it is relative to where it's been in the past, so we'll just look at 30 here and then simple. You know, we are in the 5th percentile in the past year. If I go out to the last 5 years, we are in the 22nd percentile. There aren't very many other levels. If you kind of look across my cursor to the left, there's been a few other times we've been this bearish, but we were on a bearish trend there, a long-term bearish trend. Same thing here. We're at the end of a long-term bearish trend. Here we're actually on pullback mode. So we have an opportunity. We're pretty oversold. I think you're going to get an opportunity to really buy this bounce and the euro, sell what would then be the dollar drop. The dollar appears to be peaking at these levels. If you look at the DMI for this, you see how strong that rally is. It's a rising PPO on this, about as high as we got over here. So we'll kind of keep our eyes to see how much longer we stay that bullish. If you look at the long-term crossover chart here, you see that we are down at that 200-day moving average. That's a very significant support level for the Euro-US dollar. That's why I don't think there's a whole lot of downside, especially with, you see how we're not getting the long lower shadows anymore. The long lower shadows, you remember, you can fill those in on the downside. But when you end up closing near the low and you don't really push down very much lower, this is what the candle chart looks like, then that's what your chart looks like right there. And that can be when you get these smaller, you get these big bearish moves, then you get a very small week, which is what this is, a weekly chart, then that can be a reversal, kind of like a morning star candlestick pattern, or whatever you want to call that. When you have a big candle to the downside, very small doji, and then following, you would expect that it would follow up with a big candle to the upside heading into next week. To kind of show you what that's done to gold, gold has fallen back down from that 38% Fibonacci retracement level, as we talked about, as it would. I don't expect it to stay too much down here to the downside before we turn back up. It's also having its impact on commodities as a whole. We still have not had the main selling in the commodities yet. We haven't started the pullback below the 23% level. Again, another reason why we're not nearly as bearish as we think we are, because it hasn't bled its way into other asset classes. Bonds, which have been so bearish, and this PPO is so low, watch for that to start working its way back to the upside. We're obviously the lowest level of the past 5 years for TLT, the lowest level of the past 10 years for TLT on the PPO, and then you go out the last 20 years, and it's the lowest level of the last 20 years. So very, very significant low level, sitting at relative support at that 62% Fibonacci retracement level of this rally we've been in. So, if we don't hold support there and we break, then we are headed down, even further down, potentially down to this 115 area. But I think there is still, there's some pretty decent support in this spot. If you look at the long-term volume profile for TLT, because again, you can kind of see it's not a big trender. But if we take a look at, what was it, the 10-year chart, I believe, that we were looking at, that's where the top of the value area is right here. So, again, another reason why you would expect this to act as a significant support. And of course, if we bounce here, that usually means that we are in Fibonacci retracement area. So, in terms of risk appetite, so we'll see how that plays out, because even a short-term bounce up to this 38% level would signify a risk-off move across all these other assets, especially equity asset classes. Remember, we are getting a risk-off move in the NASDAQ. We are getting even more of a risk-off move. We already had a risk-off move in the NASDAQ. We're getting even more of a risk-off move in the Russell, and it still hasn't really gone completely, like, we haven't seen the sell-off yet in commodities, the exhale yet in commodities. We haven't seen the exhale yet in the dollar, or in the euro. We have seen it in the dollar, excuse me, and we haven't seen it in long-term bonds. Those yields are still very, very high, but I don't think that they'll be this high for very much longer before we do roll things back a little bit here to the downside. Just an exhale down here to the downside, bounce in bonds before we resume this bullish long-term trend in yields. My opinion, by the time we get to the 2022 elections, we'll be up in this area, above 2%, closer to 2.5%, by the time we get to the November 2022 time frame. All right, so now let's take a look at the sector moves, and you can see communication service had a really nice snapback rally today, and those media companies especially been hit really hard. So a little bit of an oversold technical bounce, but look at what else is doing really well today. Utilities and consumer staples. So that whatever little strength we got in the SPY did not come from XOK, XLY, a little bit from XLC, but mainly from safe haven areas. So again, and you can see energy financials, the two biggest winners from that September low point, They are like by far the two biggest winners. You can see they're pulling back the most, which is what you would expect in that. And you can take, if you take a look at the 12 grid here, again, we're seeing some nice, good bullishness. Real estate and overbought cluster, utilities, dark green shading, green line, staples, overbought cluster, very, very bullish in these safe haven areas, even healthcare. Not so much in some of these other areas, right? You can see the divergences setting up in industrials and materials, energy lower high, financials lower high and rolling over. We've already got light pink shading, dark pink shading, light green shading with a yellow line. I mean, these are all bearish patterns that you expect will bleed themselves over, like I said, into more weakness by the time we're done by the end of this, again, holiday shortened week. All right, so that brings us to our trade idea of the day, and I want to take a look at Qualcomm. Qualcomm is in that XLK space. Again, remember it actually started its intermediate pullback a lot earlier than the QQQ did. But very similar to the QQQ, had most of its pullback early. It's been kind of sideways late, but now the moving average has kind of caught up to it and is acting as a resistance for it, with the possibility that we could be rolling down from that. If you take a look at its chart here, we got a red arrow, the MACD histogram rolling back down to the downside. If you take a look at the two-line version of the chart, you can see we are back down below the 17-day moving average. We were flirting below the 8-day moving average at the time we were looking at it. Stochastic's breaking back down below its moving average. MACD is still negative. If you take a look at the Bollinger Bands for the stock, you can see you got some very strong resistance up above where we're at, and we've got a pretty decent volume node building right now with not very much support down below you until we get down to about 115. Or so. We're at 131 right now. So the bandwidth is dropping down, so giving us an opportunity for a new breakout, right? A new expansion of the bandwidth to occur. But which direction, right? Well, right now you'd have to guess in the direction of the downside because that's the trend, and you've got less support below us and resistance above us for that to happen. If you take a look at the long-term chart here, you can see we are kind of flirting with that 200-day moving average, and we have opportunity to come down towards it. Remember we said 115, but the PPO is dropping. We're still easily above the 200, and that's the space we had to fill in down to the downside. So not a big directional move opportunity, but enough of a bearish, some resistance in this area that we can look at doing just a bear call spread. So not a long put vertical, but more of a short call vertical spread where I can sell the 140, buy the 145. It sets me up for this bear call vertical spread, a normal position sizing because we do have earnings coming up, but hopefully we might be out of this trade before earnings. As you can see, as long as if the stock falls quickly, if it falls down to even just 125, we might be able to get 50% of our maximum gain early. And as long as we can get 50% anywhere outside the 20-day window to expiration, then we'll take it and move on to another trade. Use that capital to try to make up the other half and then some on another trade. This considering how fast these bearish moves can last and move, and us being able to lock in those gains relatively quickly. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. It takes you to our Market Outlook forums. Remember, all of our paid and our free subscribers get access to that forum in particular. That way we can keep this conversation going with other viewers, other members of our Market Scholars community. Post any reply or threads, new threads, reply to others' threads. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, as well as like us on Twitter and Facebook too, and then comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all next time.